Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Nick Greenwood, manager of the Miton Global Opportunities Fund, to give his three stock picks. Hello, Nick.
Morning.
So it's called three stock picks, but it's not actually going to be three stocks, is it? Because your trust can invest in a very diverse range of assets. So the first one is a property play, isn't it?
Taliesin, Berlin property. I think I'll take rather longer than 3 minutes to explain why I'm bullish, but it's almost without parallel. The city's gone from an urban wilderness to a major European capital since 1992. So I think there's a lot more movement to go. But the real arbitrage is the fact that in Germany most people rent, therefore renters are voters. There's a lot of landlord unfriendly policies. And Taliesin is in the process of splitting up its apartment blocks and selling them off as what we understand as leasehold, away from the dead hand of regulation. At the moment, you would get about €4,000 a square metre for a flat. They're valuing them in the stated NAV as rental properties, i.e. highly regulated, at around €1,900 a square metre.
So a real sort of uptick then in what they're worth. And you were saying beforehand, before we started rolling, that you could rent in Berlin a sort of two-bedroom equivalent of Zone 1 in London for £300 or £400. Now, for those who don't know London property, you can sort of rent an equivalent in London for arguably 7, 8, 9, 10 times
Probably
that.
not Zone 1, but the nicer parts are Zone 2. So these bits would probably be more like Shoreditch rather than Kensington
Mayfair,
or Mayfair. But, you know, generally speaking, the prices in Berlin are about a seventh for those in London and about half in Munich.
So those restrictions don't exist. That's only for the rental market.
Yes.
Whereas what you're talking about
exactly.
is
When you take the property out of away from the dead hand of regulation and it's on the open market, then it is worth a lot more. There's a lot of regulations that restrict the rents you can charge your tenants, etc.
So what's the second thing you'd like to highlight today?
Well, second-hand life policies in the States, it's a subject that can be a little bit controversial. There have been one or two disasters in the open-ended world because the underlying assets are completely illiquid. But it's again, it's a situation where the methodology working out what a second-hand life policy, in this particular case, massively understates the proceeds the investment trust will get when policies mature.
This is, of course, another sort of key theme in the investment trust world as a whole, isn't it? Investment trust, originally, if you look at one of the first ones ever set up, Foreign and Colonial, invest in large liquid equities. And now, of course, what investment trusts are really good at is investing in these securities, these assets which are less liquid, the sort of things that you couldn't invest in through an open-ended fund. But the investment trusts do very well because of their structure. Property, life endowments, etc.
Yeah. I mean, it's the strength is that they protect the fund manager from the inflows, and therefore a fund manager can take more conviction. They can take a strong view. They know they can sit around on the investments, and when you get into alternative assets, the underlying assets can be incredibly liquid. So, property, if you were getting redemptions in open-ended funds, you're sent into the market to try and sell buildings. Whereas with an investment trust, the share price might take a hit, but you can get out at a price. But there's no destruction of capital at the portfolio level, where the fund manager is sent in to try and sell an asset which might take you months to sell in a fund that's giving its investors daily liquidity. You get this fatal mismatch in an open-ended fund between the liquidity available to the fund manager and that's available to the customer.
And what's the third holding that you'd like to highlight?
Pantheon, which is a private equity trust. There's a lot of uninvested money looking for a home in private equity at the moment. I think the Financial Times came out with a figure of $1.2 trillion. That money will get spent, which means if you actually own the assets that private equity buyers are looking for, i.e. unlisted companies, it is one hell of a seller's market at the moment. And the redeemable shares of Pantheon currently trade on a 34 discount. Yet, I think as they sell their mature assets, I expect that NAV to rise. So deeply unloved at the moment. Maybe it's because people have memories of what happened in 2008 and a number of these trusts nearly went bust. But that was a certain set of circumstances, and these shares just look too cheap.
And you've got three very diverse assets there, arguably three that held their own unique risks, but together that diversity helps to counter the individual risks of those assets.
Yes, I mean, if you look at the Miton Global's portfolio, you've got a very lowly correlated portfolio. The main themes, as I said, are residential property in Berlin, second-hand endowment policies, private equity, I'm not particularly bullish on mainstream equity markets, and therefore we have very little exposure to them at the moment.
Nick, thank you very much.
Not at all.
This is Emma Wall for Morningstar. Thank you for watching.